What is up, investors? Back again, another stock analysis. Today, we're going to take a look at a mall REIT, Simon Property Group, ticker symbol SPG. This is by request. If you have a stock you'd like for me to cover here on the channel, leave me a comment below. I'll get to it as quickly as I possibly can. So we're going to take a look at Simon Property Group. They've made a little bit of news. We'll take a look at some of the properties that they own. We'll take a look at little bit of evaluation, kind of analyzing a little bit of valuation. They've made some news. They're going to have like a trial and a lawsuit. They agreed to buy this company, Taubon Centers, and then they backed out once this whole virus thing started kicking off. They're backing out, and we'll see what happens there. I'm not a lawyer or anything like that. Then we'll jump into the financials, just briefly kind of take a look at what's going on here. We'll take a look at the most recent quarter that ended for them, March 31st. And we'll take a look just briefly how you analyze REIT. This is a real estate investment trust, otherwise known as a REIT. And so REITs have their advantages because by law, they have to pay out, I believe it's 90% of the profits to you, the shareholder. So owning a share of SPG or any REIT, they treat you very much like an owner of the company, whereas some stocks, they don't pay you anything. Here we can see the dividend rate is $8.40. So by one share of this, you're going to get $8.40 per share. Buy 10 shares, you're going to get $84 worth of dividends just this year. That would be over a share in reinvestment at the current price. That is a forward yield of 13.57. If you have money in a bank account or have seen interest rates these days, 13.57%. Now, there is some risk involved in that, and we'll talk about that just in a minute. What I wanted to do, actually, very first thing I wanted to do was max out this chart. Take a look. We haven't seen, this stock is trading at $60. We haven't seen these prices back in like 2005. We're talking about 15 years ago. And then obviously we had this is right during the financial crisis here. Boom, the stock went down to about the $30 range, not far from where it crashed to just a few months ago. And then look at the volume. I don't know if you can see this grayed out area. This is volume. This volume even goes over the bars of the chart. So that's huge volume. And you're seeing it here. We're seeing huge volume in Simon Property Group. So I don't want to say that history repeats itself, but we can take this as a guide. When this stock fell off a cliff, it traded sideways for a little while, and then it made a steady rise all the way up to $200 a share. Now, it's had a little bit of a rough going more recently. This stock has kind of fallen off from this $200 level, and then boom, we have the virus happen, kind of in the United States at least, back in March. And so this stock is really traded off and has really gone sideways. We see here in a 52-week range, it's trading more closer to the low, which is contrary to a lot of stocks that we've analyzed, from Adobe to Beyond Meat to a lot of stocks have been making their 52-week high recently. This stock is still lagging the rest of the market. So in my opinion, that actually makes it attractive and probably is a closer to a stock that I would be interested in buying at the current time than stocks that are making a 52-week high. The 52-week high is $165. 52-week low is $42. So again, this FFO, just very briefly, I don't want to bore you with kind of the technicals, but that's funds from operations. And so Simon Property makes money, but they also have to depreciate the assets, but that depreciation is non-cash. And so, but they have to recognize it on the balance sheet, and we'll take a look at that in a minute. So that's what this price to FFO, think of it as like price to earnings or price to sales. That's how you analyze most stocks. But with REITs, which Simon Property is, you take a look at this price to FFO and notices it's at 6 and the forward's at 10.5. I want to show you really quickly. This is the sector median. So this is like a broad range of the sector. And notice where this stock is. It's trading at price to FFO forward is 6, and the industry average is about 13. I would double check to make sure this is coming from Seeking Alpha. I'd double check, maybe compare this against some other major mall REITs and just see if these numbers line up. But boy, this stock seems like it's very nicely undervalued based on some traditional metrics. Now, one of the reasons why it might be undervalued, The mall traffic and just malls in general have been falling out of favor with investors and even shoppers and consumers for a while now. But we see here, remember when we had this chart maxed out? Okay, malls have been out of favor and people haven't been quote unquote shopping at malls for a very long time. Notice right after the financial crisis, look what this stock did over the next, call it 10 years. This stock made a steady stream up and malls were falling out of favor all during this time. So it's not like malls are going away. I believe they're going to have to evolve, especially in the age we are at now. So we see here malls and premium outlets make up the vast majority of this company's properties that they own, close to 80%. So that's something that you want to keep in mind, and that is a risk. If mall traffic and store traffic in general doesn't bounce back because of the coronavirus, things are going to have to change at malls for SPG to continue to make lots of money. Now, another thing that was interesting is they agreed to buy this company here, TCO, Tall Bond Centers. But they decided to back out of that. So they backed out and it's going to get messy. They'll have a trial. My guess, at least from some of the analysts that I've been reading, is SPG is likely going to have to pay some hefty breakup fee, or these two companies are going to have to get back together and maybe agree to some different terms for the merger. We'll see what happens here. I don't think it's going to be super tangible for investors, but this might keep a cloud over the stock for a while, might actually allow you to acquire this stock at these prices for a little while. And I think obviously with all the other stuff going on in the world and with malls still being out of favor with a lot of people and shoppers, I think you're going to be able to gobble this stock up if that's what you want to do over the next few months. I don't think you're going to have a problem with that. Let's jump into the financials. We take a look at assets here. We've got their investment properties at cost. This is what they paid for them. So it's stayed relatively flat. They haven't made a bunch of acquisitions. They haven't bought any properties. That might be kind of interesting. You might have, other REITs or other mall operators have trouble paying their bills, and maybe SPG has the balance sheet and the means to buy it. So they might be able to gobble up some things at a good price. Now, you see here this accumulated depreciation. So this gets minused out here. This is $14 billion, but this is not cash. They didn't have to pay $14 billion to somebody on depreciation. They have to just recognize that on the balance sheet. It's just kind of like accounting rules. Now, we can also assume that it's likely that the properties themselves didn't necessarily depreciate by this much. They just have to recognize this based on kind of, GAAP financial and accounting rules. So it gets us down to these total assets of about 34 billion, but it's offset by the liabilities, because just like you maybe have a mortgage on your house or maybe a car payment, you still owe quite a bit. And so we see here, this is mortgages and unsecured indebtedness. So they own call it $38 billion worth of properties, but the mortgage and kind of outstanding balance on that is 27.5 billion. So it's not like this company owns a lot of these properties outright. And if we look at total liabilities here, we've got quite a bit of liability in comparison with the assets, which is not too uncommon when you look at REITs and stuff like that. They're meant to kind of run at kind of a really balanced level here and just distribute a lot of the profits to you, the common shareholder. Now, what you want to do here is take a look at revenue, because like I said, this company is paying $8 a share. They're paying $8 a share in dividends every couple months. They're paying you $8. That's amazing. This is for a whole year. And so they're paying you $8 a share for a whole year. That is a 13% dividend at the current price. And so what you want to do is actually make sure you see how safe this dividend is. One thing you could do is immediately drop down to the earnings per share, but what you want to remember is there's a lot of cost in here, a lot of operating expenses and things like that are not necessarily cash. And so when you see this $1.43 in earnings, you could annualize that out and it'd be maybe $6 in earnings, and they're paying $8 in dividends. Obviously they're underwater if they only earn $1.43 per share. and they pay $8 in dividends. So that's not that great. Again, you have to annualize this number because this is on a quarterly basis, and this $8 mark is on an annual basis. But what you want to do is come down to cash flows. This is really what you want to do. You want to take a look at cash flows, because what they do is they add back in this depreciation. So here we got our consolidated net income here, this $500 million mark, but we can add back in this depreciation because this wasn't cash. This net income treats this depreciation as if it was cash. You can go ahead and add that back in, and we've got this net cash here provided by operating activities at $741 million. We see how that compares to the previous period of $837 million. I can imagine, okay, this is March 31st. This is just a little bit. This is just a couple weeks of COVID-19. I can imagine a lot of tenants at Simon Property wanted to renegotiate rent or not paying rent at all. So these numbers I would expect to continue to decline in the next quarter and probably the subsequent quarters to come, especially the longer this thing kind of hangs around. But here's my main point: is what you want to do is come down here and look at dividends. So we've got preferred dividends here. We've got here we go. Distribution to stockholders and preferred dividends. This is how I think you get a much truer view of how well this company can cover the dividends. So they paid $645 million. Again, by law, the REIT, Simon Property Group, has to pay 90% of the profits that they make to you, the shareholder or the investor. So here we go. We got $645 million worth of dividends, and they made 741. So if this number again, this dividend, unless they cut it, is going to remain at 645. And maybe it goes up. Maybe they have relationships with the preferred dividend, or they decide to raise the dividend. I don't think they would do that anytime soon, at least by any significant amount. But again, Simon Property needs to generate positive cash flow in excess of 645 to not just like dip into their balance sheet in terms of cash flow to cover this dividend. So to me, this would be the one thing that I would definitely pay close attention to on the next quarter when Simon Property Group reports again. See this trend. Okay, we went from 837 last year down to 741. Does it go to 641? Does it go to 541? Let's see how low it goes and see how distressed a lot of their properties become. And then you start worrying about this dividend. But from right now, it looks okay to me. Now, they did issue quite a bit of debt. You see here proceeds from issuance of debt. They got $2.5 billion the year before. They issued more debt. That's where a lot of the cash, if you look at their balance sheet, a lot of their cash came from this issuance of debt here of about $6.4 billion. Because again, we're making 741 on the operating side in terms of cash flows, but we're paying out a good, again, close to 90, actually over 90% of that in terms of dividends by law. So Simon Property Group, buy, sell, or hold. Honestly, I don't mind if you want to speculate a little bit here, but I want to let you know about the risk. First of all, this dividend yield is sky high. 13% makes me worried. That makes me feel like investors are worried that this dividend is going to get cut. If this dividend gets cut to a significant degree, you'll likely see this stock trade down even further. So that's your risk number one. Number two is you have all this exposure to the mall properties. And if traffic doesn't come back to malls, if shopping doesn't come back due to a lot of different reasons, then obviously the tenants at Simon Property Group are going to be going out of business. They're not going to be paying rent. There's not going to be new tenants going to come in and start renting those properties out. And so it could leave Simon Property Group in a tough situation where they've got to cut this dividend further. So with that in mind, I would inch into Simon Property Group. I don't think there's going to be this catalyst that's going to shoot this stock higher. This stock, as you saw here over the last 5 years, was really steady, okay? Even on a 10-year basis, it steadily churns up. Okay. This is not like a Tesla or a Beyond Meat that's going to have these big up and down swings. I think we actually see one here a little bit, but I think the situation we're in now, this stock is going to trade sideways. So, say you had $1,000 you want to throw at Simon Property Group. I would inch in a share here, a share there. We've got free trading, we've got fractional shares. There's no reason that you need to buy a full position in the company from jump. So, inch into this one. I totally don't mind it. I might even do that. I'm definitely going to add this to my watch list, kind of keep an eye on what things are happening to this company. I definitely want to keep an eye on this cash flow to see how this is affected month over month. If this cash flow stays steady and things look good and looks like they're going to be able to cover this dividend, I think I'd like to buy some more shares when they report their next quarterly earnings. So that's my analysis of Simon Property Group. I give the green light to maybe inch into this one, and I haven't given a green light really on almost any stock that I've analyzed recently because they're all trading at this 52-week high. This one's closer to a low, so I think you have some downside risk down into that $40 range, and if they cut this dividend, especially significant, if they cut it in half or they cut it 30-40%, boy, you have even further downside than probably even this $40 mark. That's why I would very gently tiptoe into this stock. And like I said, this is not a stock that's going to swing wildly. Typically, REITs are not that way. You're investing in them for the dividend, steady stream of dividend income, and that's what you're doing here with Simon Property Group. So I hope that analysis helped you out a little bit. If you have any comments or questions, feel free to leave them below. I'll get to you as soon as I possibly can. Hit that subscribe button if you like what we're doing here on the channel, and that like button as well. Thanks for tuning in. Good luck with your investments.